Okay, dear students, first of all, welcome to every one of you. They are present right now here. Students, from here onwards, every revision class is going to be a difference making class. Those they are unable to attend the live class, they must watch the recording. Because in today's class, you will see by the end of the class that how much you have revised and how much you have learned. And of course, every week, like today, the plan is to go for 3 questions, but the coming Saturday, the plan is to discuss around 5 to 6 questions, all from the recent past papers. All will be the new questions. They are not already uploaded on the portal. So let's start the discussion. And question number 2, we are first discussing the paper is your March-June 2025. Question number 2, requirement 1. In accordance with IFRS 9, financial instrument, discuss the accounting treatment of transaction in Exhibit 1 in the financial statement of buy float for the year ended 31st December X7. How many marks? 8 marks. In accordance with IFRS 9 financial instrument, discuss the accounting treatment of transactions in Exhibit 1. In the financial statements of by float for the year ended December X7, there are transactions. We have to read the question. We just need to discuss the accounting treatment according to IFRS 9. And look at the exam, they're saying just discuss. So normally you will not find any numerical area over here because the question itself says just discuss, 8 marks. Then part B relates to the ethics. Right now, I'm not going for part B. Let's start with part A, financial instrument, IFRS 9. Of course, if I am facing a question on IFRS 9, so I have to have a really good grip on financial assets, financial liabilities, moving forward, categories of, I would say, financial asset, classification of financial asset. For example, if I have made an investment in shares, equity instrument, investment, just okay. IFRS 9. For example, if my company has made an investment in equity instrument, there are 2 possible classifications. One is fair value through P&L, and another is fair value through OCI. Number 1, this classification is only initially possible. Number 2, if you want your investment in equity instrument to be classified as fair value through OCI, other comprehensive income, number 1, make sure it should not be the investment for short-term trading purposes, because if your investment is for short-term trading purposes, then it has to come into the P&L category. So number 1, it should not be a investment for trading purposes. Second, you have to make an irrevocable election. Only after making an irrevocable election, you can bring your equity instrument to the fair value through OCI, and plus it is only possible initially. Second, the default category is fair value through P&L category. Nothing is mentioned whenever I'm making investment in equity instrument, then simply the default category is a P&L category. If you just recall the transaction cost, in OCI category, we technically add the transaction cost to the fair value of financial asset. In P&L category, of course, we expense out the transaction cost. Plus, if I talk about impairment, you have an investment in equity instrument. Investment in equity instrument has nothing to do with the impairment under IFRS 9. Now, if you're making investment in debt instrument, if my company is making investment in debt instrument, there are 3 possible classifications. One is amortized cost. Now, what is amortized cost? Amortized cost is only possible when company will hold the investment till maturity. The business model is to hold investment till maturity. That is the business model. We'll keep the investment till maturity. We are only interested in contractual cash flows. If my company has made an investment in debt instrument, there are three possible classifications. One of them is amortized cost. When I say amortized cost, two things are very important. You can say two tests are very important. One is I have the intention, I have the ability to keep the investment till maturity. Second, we are only interested in contractual cash flows. When we say contractual cash flows, then logically there are two things in contractual cash flows. One is the payment of interest, which we will be receiving it. And the second is principal payment. So when we say contractual cash flows, it means on a specific date, you will be getting the interest income, plus you will be getting the repayment of your principal amount as well. Logically, when both the tests are met, only then you can take your investment to the amortized cost category. But a good thing is, even both the tests are passed, still if your company says we don't want to keep that investment at amortized cost, you can do that. But the concept is, if you really want to follow the amortized cost category, then you have to pass, your investment must pass both the tests. Okay. Now let's say I've kept my investment at amortized cost, then in the P&L, finance income will be recognized by using effective interest rate. Finance income. Which goes to P&L, that will be by using effective rate. And that effective rate will be given to you, don't worry at all. But if someone asks you a question, how do we calculate effective rate of your investment? The answer is IRR. Logically, IRR of my investment is the effective rate of interest. But finance income is always recognized on the basis of effective interest. Cash interest is actually received by using the coupon rate. Coupon rate is the rate which is written with the bond. If I say you have invested in 8% bonds, so that 8% is a coupon rate. That 8% actually represents cash interest rate, which means every year your company will be getting 8% interest. And cash interest is always available on par value. Another thing, if you have made an investment in that instrument classified at amortized cost, then initially your investment will be kept at fair value plus transaction cost, then subsequently, of course, at amortized cost. Now, another point is, if I've made an investment in debt instrument, which is kept at amortized cost. Now, under IFRS 9, impairment accounting is applicable when you have an investment in debt instrument and you have kept that debt instrument at amortized cost category. Plus, there's one more, we'll be discussing that also. But under IFRS 9, the impairment accounting is applicable when you have kept the one you have made an investment in debt instrument. Second, let's say it is at amortized cost. Now, how do we actually apply impairment accounting under IFRS 9? It is very different as compared to IAS 36. Under IFRS 9, basically what happens when you have made an investment, then initially company goes for 12 months expected credit loss. Initially, I would say we prepare 12 months expected credit loss. Simply, your loss allowance will be on the basis of 12 months expected credit loss. The question is, what do you mean by 12 months expected credit loss? Basically, I've just made an investment. So initially, what I'm going to do, my company is going to check there what are the chances the investee where I have invested where the company in which I have bought the debentures, bonds, what are the chances in next 12 months that company will default? So obviously, when everything is fine, so chances would be very less that company will default in next 12 months. So while estimating, I would say, loss allowance for the next 12 months expected credit loss, my company is going to estimate what are the chances investing company will what are the chances in next 12 months simply investee company will default. Obviously chances they will be very less. Second, I'll check in the event of default how much I'm going to get it back. For example, if I've invested $1 lakh, so when in the event of default, will I be able to get my entire financial asset? Will I be able to get entire amount or not? So basically, when initially you will be making the loss allowance according to 12 months expected credit loss. Even subsequently on each SOFP date, still there's a possibility you will be preparing in loss allowance according to 12 months expected credit losses, provided that the risk of default, the credit risk has not increased significantly. Means everything is fine in that investee company. Assuming investee company itself is a financially strong company, it was initially, I would say, financially strong. Still, it is a very strong company. Credit rating of the company is very good. Plus, the investment which I have made in the bonds, those bonds are behaving normally. Nothing any abnormal is happening on those bonds. It means there's no significant increase in the credit risk. Again, in that case, even subsequently, you will be preparing your loss allowance according to 12 months expected credit loss. But if subsequently credit risk increases significantly, when the credit risk increases significantly, then instead of 12 months expected credit loss, then we prepare our loss allowance on the basis of lifetime expected credit loss. Now, what do you mean by lifetime expected credit loss? For example, till maturity, we still have 3 years. Lifetime expected credit loss means we will see what are the chances company will default after 1 year. What are the chances company will default after 2 years? What are the chances company will default after 3 years? If I'm doing this, it means I'm making the loss allowance on the basis of lifetime expected credit loss. But normally, when everything is okay, there's no significant rise in this credit risk, then your loss allowance for the impairment will be on the basis of 12 months expected credit losses. So when there is no significant rise in the credit risk, then even subsequently loss allowance will be on the basis of 12 months expected credit loss. If there is significant rise in the credit risk, then loss allowance will be equal to lifetime expected credit losses. Actually, lifetime expected credit losses means, for example, let me give you the example again. If assuming when I invested at that initially, time period to the maturity was 5 years. Everything was fine initially. But at the end of second year, my company has realized that credit risk has increased significantly. Then I'll be preparing my loss allowance on the basis of lifetime expected credit losses. Now, initially, the time period of the maturity was 5 years. Everything was fine in the first 2 years. After that, things are not good. Now, what I'm going to do, so we have still 3 years to the maturity. Lifetime expected credit losses means now my company will assess what are the chances company will default after 1 year, after 2 years, after 3 years. If the default occurs after 1 year, how much I'm going to get? If the default occurs after 2 years, what I'm going to get? If the default occurs at the end of 3 years, what I'm going to get? If I'll be preparing my, I would say, loss allowance by using such calculation, then it is lifetime expected credit losses. Okay, now. But the accounting of impairment is only applicable in two situations. One of them is when you have made an investment in debt instrument and you have kept that investment at amortized cost. Now, there's a possibility. The second possibility that we have made an investment in debt instrument, but we are keeping at fair value through OCI. Now try to understand this fair value through OCI. Actually, when we say fair value through OCI, business model you need to understand first. To hold investment till maturity plus sell. I'll come to this sell. And the last, another point is contractual cash flows. Company will be collecting the contractual cash flows. Now the question is, what is the difference between this business model and the previous? Actually, at amortized cost, the business model is just to we'll hold the investment till maturity. But in case of fair value through OCI, we are saying we do have the intention, we'll keep the investment till maturity, but we say plus sell. Now, sell means what? Try to understand. Sell means my company says, okay, we'll keep this investment till maturity, but after 1 year, 2 years, even after 6 months, if I come across any other investment opportunity which is going to give me the return even higher than the existing investment, so obviously I'm going to sell my existing investment in order to get that, in order to basically grab that opportunity which is available to us. So this is your business model, that if you come across any investment opportunity simply which will give you a higher return than your existing obviously investment, so you're going to sell it. So this makes business model different as compared to when we were discussing amortized cost category. In amortized cost category, we don't have any intention to sell. So I'll keep the investment in debt instrument at fair value through OCI when my business model is to keep the investment till maturity plus sell. And plus, again, I'm only interested in contract. I'll be only getting actually contractual cash flows. One is interest and another is principal amount. Question. Please, students, when we are making investment, what are we discussing? Fair value through OCI, fair value through P&L. When we make investment in debt instrument, there is no such concept of irrevocable election. Irrevocable election only relates to when we are making investment in equity instrument. When I have made an investment in equity instrument and I want those equity instrument to be classified at, under fair value through OCI, only then irrevocable election. But when I'm making investment in debt instrument, there's no such election. Okay. Let's go back to fair value through OCI. It's here. Now listen. Under IFRS 9, again, impairment accounting is still applicable. If you have made an investment in debt instrument, you have kept that investment at fair value through OCI category, yes, under IFRS 9. Again, I'm going to follow that expected loss model. That is, if everything initially, your loss allowance will be equal to 12 months expected credit loss. Even subsequently, still at 12 months, if credit risk has not increased significantly, if subsequently credit risk has increased significantly, then your loss allowance will be equal to lifetime expected credit losses. Third and the last one is you have made an investment in debt instrument, but for trading purposes. Then it is fair value through P&L. In case of fair value through P&L, simply you made the investment for short-term trading purposes. So when you made an investment for trading, then you will keep the investment at fair value through P&L category. Only when your financial asset is at fair value through P&L category, transaction cost is expense out. Otherwise, in every category, initially you will keep your investment at fair value plus transaction cost. Okay. If I talk about financial liabilities, there are two possible classifications in case of financial liabilities. One is amortized cost. Another is fair value through P&L. According to IFRS 9, majority of your financial liabilities, for them, the suitable category is amortized cost. And that makes sense as well, because if my company has issued a debenture, which has the maturity period of, let's say, 4 years. So I exactly know that when I'm going to pay how much interest, and at maturity, what amount I'm going to pay. I know that. So in that case, basically, according to IFRS 9, which is again, I would say logical, most of the time your financial liabilities, for them, a relevant classification is amortized cost. If there's a financial liability kept under amortized cost, then transaction cost is actually deducted. In case of financial liabilities, transaction cost is deducted from the proceed which you have raised by issuing the debentures. But if your financial liability is kept at fair value through P&L category, then transaction cost is expense out. And either fair value through P&L or amortized cost category, this classification is only available initially, and their lock category reclassification is not possible. Like from fair value through P&L, you cannot bring your liability to amortized cost. From amortized to, you cannot go to P&L category. Now, in case of fair value through P&L category, of course, initially you will keep your financial liability at fair value. Then on each reporting date, you will keep the financial liability at fair value. But the main point is, assuming initially the fair value of your financial liability was 200,000. I'm just assuming, okay. At year end, let's say your financial liability fair value has become, assuming 250. So there's a rise of 50,000. Number one, when the financial liability fair value increases, technically it is a loss for the company. According to IFRS 9, when you have kept your liability at fair value through P&L category, then the change of the fair value you have to split into how much change belongs to own credit risk. The change which belongs to own credit risk, assuming it is 20,000, then balancing figure is the change which belongs to other factors. Now listen carefully. The change in the fair value which belongs to own credit risk, again the risk of default, that goes to OCI. This 20,000 will go to OCI, and the balancing figure actually goes to P&L. Repeat. The change in the fair value, which actually relates to own credit risk, that goes to OCI, and simply you can say the change which belongs to other factors, that goes to P&L. Okay. Now, simply come to the question and read the requirement again. In accordance with IFRS 9, financial instrument discuss the accounting treatment of the transactions in Exhibit 1 in the financial statement of by float for the year ended December X7. Let's see. The question. Biofloat operates in the football industry. It prepares its financial statement using IFRS accounting standard. The financial year end is December X7. The following exhibit available on the left hand side, green, okay, financial assets. So we are talking about investments. Provides information about financial asset held by float. Ethical issues we'll be discussing. Just wait. This information should be used to answer the question requirement within the response option provided. By float acquired 5% of equity share capital of Valita company some years ago, but did not make an irrevocable election at initial recognition date to measure the investment at fair value through OCI. Simply, if you did not make an irrevocable election for OCI, so definitely your investment in equity instrument will be classified, or should have been classified under, can I say, fair value through P&L category. Is that clear, students? If there's no irrevocable election, so obviously then investment in equity instrument should be at fair value through P&L category. Subsequently, Valita experienced significant operating losses and Bayfloat provided a substantial loan to Valita on normal commercial terms. Valita experienced significant operating losses. Bayfloat provided a substantial loan. So for Bayfloat, for whom we are solving the question, they are providing loan to the Valita on normal commercial terms. So this loan is simply a loan receivable, normally financial asset. Bayfloat financial asset is loan receivable. Okay. At January exchange, Bayfloat still held the 5% equity share capital of Valita in addition to having a significant loan receivable, which was correctly measured at amortized cost. Okay, that makes sense. Then you have kept your loan receivable at amortized cost. Okay. October X7, Bayfloat agreed to write off half of its loan to Valita in exchange for the further 10% equity shares of Valita. Now, what is happening? 31st October X7, Bayfloat agreed to write off half of its loan to Valita in exchange. How much Valita is going to get? They will get 10% of equity shares. Bayfloat will get 10% of equity shares of Valita. The fair value of the shares received in exchange was considerably lower than the carrying amount of the loan receivable. Now listen. At October X7, Bayfloat agreed to write off half of the loan. Now what is happening? We are writing off half of the loan and we are against that we are receiving shares. The fair value of shares received in exchange was considerably lower than the carrying amount of the loan receivable. So if you read it nicely, I can see the loss. Assuming in exchange of half of the receivable, if you're getting the shares, assuming the fair value of those shares is 20 million, but the half of the carrying amount of the loan is 25 million, then 5 million is simply your loss. So definitely the loss goes to P&L. So Bayfloat agreed to write off half of the loan to Valita in exchange for a further 10% equity. The fair value of the shares received in exchange was considerably lower, so that I can see a loss. The loss will be charged to P&L. December X7, Valita was unable to repay the interest falling due to the remaining loan. Valita was not even able to repay the pay the interest falling due on the remaining loans. Now, student, listen carefully. Exactly what you are going to discuss. Number one, you can simply discuss about this equity instrument. Simply, you can say when company is making investment in equity instrument, then there are two possible classification. One is fair value through P&L, and another is fair value through OCI. After that, you have to explain in order to keep the investment at fair value through OCI category. Initially, company will have to make an irrevocable election. Only then fair value through OCI category is possible. Under OCI category, what do we do? Initially, we recognize the financial asset at fair value plus transaction cost. Okay. Then subsequently, will it also be at fair value through OCI category, and changes in the fair value will go to OCI. So that is good enough. And here, now apply this on this question. So you can say if buy float has not made, simply did not make any irrevocable election. So their investment in Valita will be kept at fair value through P&L. That is the investment in equity instrument. Now, Valita was unable to repay the. Now let's discuss the loan receivable. Number one, loan receivable is a financial asset for the company. Loan receivable is a financial asset for Bay Float, and Bay Float is falling amortized cost category, which is, I would say, correct. Falling amortized cost category, there's no issue at all. But what is the problem and what is happening? Bay Float agreed to write off half of its loan Valita in exchange for a further 10% equity. So there's a transaction in which half of the loan will be de-recognized, 10% of the equity will be recognized as an, of course, financial asset. But the fair value of those shares, they are considerably lower than the, I would say, investment in bond. So what happens? The loss, there's a loss. For example, half investment in bond is having a value of $10 million. But the fair value of shares which you are getting, they are only $8 million. So 2 million loss you have to recognize in the P&L. Plus, what you have to discuss more other than that, you have to also discuss regarding impairment loss allowance. Simply, you have to discuss initially impairment loss allowance will be at according to the 12 months expected credit loss. Second, you will have to explain even subsequently the loss allowance will be equal to 12 months expected credit losses if credit risk has not increased significantly. But here you can see that December X7 Valita was unable to repay the interest. Obviously, when companies are unable to repay the interest to you, then there are, I would say, serious concern that will they be able to pay my principal or not. So it can be seen that December X7 Valita was unable to repay the interest falling due on the remaining loan. So they should be preparing now loss allowance according to lifetime expected credit losses, not 12 months. Because you can see that December X7 Valita was unable to. So what are the findings from this question? No irrevocable election, investment and fair value through P&L goes to P&L. Simply P&L. Plus, we're going to write off half of the loan in exchange for the equity instrument, but it is quite obvious there will be a loss. That carrying amount of the loan is more and 10% of equity market value is less. Plus, you have to also discuss that at the end of December X7, it's quite clear that risk of credit risk has increased significantly. So the loss allowance should be according to the lifetime expected credit loss. Now let's just quickly see the part 1. Students, you have to just try to see it nicely. Answer is little blur, not from my side or our side, it is from ACC side. Loan exchange. December X7 Bayfloat extinguished the contractual right to receive the cash flows from half of the loan balance. This means that half of the carrying amount of the loan receivable should be derecognized. In accordance with IFRS 9, financial instrument initially recognized at fair value, so 10% investment equity shares should be measured at its fair value on the date of receipt. The difference of the carrying amount of loan receivable derecognized fair value of the equity received should be presented as a, obviously there's a loss. Why? Because loan receivable amount is more than the fair value equity which we are getting. Now loan receivable and loss allowance. Effective interest on the remaining loan receivable balance should be accrued to the year end and recognized in the P&L. The remaining loan receivable is subject to impairment requirement of IFRS 9. An allowance should have been recognized for 12 months expected credit, for the expected credit loss when loan receivable was originally recognized. Initially, the loss allowance should be equal to 12 months expected credit loss. The credit risk associated with the loan receivable should be assessed at each year end. And loss allowance should continue for 12 months credit losses if credit risk has not increased significantly, or lifetime if credit risk has increased significantly. Increase, decrease in the loss allowance, of course. December X7, there has been a default on the loan interest payment, indicating the loan is now credit impaired. Therefore, expected loss should be measured on the basis of lifetime. They have discussed investment in equity shares later. First, they went for debt instrument. There is no harm at all. First, you are answering investment in equity instrument. After you are explaining investment in debt instrument, perfectly all right. An investment in equity shares in the scope of IFRS 9 is measured at fair value in the statement of financial position with the changes in the fair value recognized P&L. Except for those investment in equity for shares, the entity has elected what? Present the changes in OCI. No such election was made by Bay Float, meaning that 15% investment in equity. Initially, it was 5, then they went for 10 more. Shares of Valita should be measured at fair value to December X7. Any gain or loss should be recognized in P&L. Of course, if while answering these questions, if a student has first explained investment in equity instrument, then investment in debt instrument is perfectly all right. And obviously, it is not necessary that you will be exactly following the sequence regarding loan receivable and loss allowance, which examiner has explained. You can even change a little bit. I would say sequence could be changed. No harm at all. But I just want to say one thing. Those students, they obviously had a really good grip on IFRS 9. They should have answered the part A very nicely. Now let's go back and let's check what they're saying regarding ethics. Using exhibit to discuss the ethical issues raised by the scenario and actions that Ms. Hayes should take to resolve these. Now try to understand. Discuss the ethical issues. One, you have to highlight the ethical issues raised. Second, the actions that Ms. Hayes should take to resolve these. And then you have to simply advise what Ms. Hayes should do it in order to resolve this problem. But for that, first we have to read. Let's see. Bayfloat has a football team in the top division of National League. The board of Bayfloat is dissatisfied with the football team's recent performance, has set out plans to borrow 50 million from the bank to spend on a new players and facilities. The new chief accountant, Ms. Hayes, is ACCA qualified. She initially applied for a permanent position but was appointed on a 9 months temporary contract, which may be extended based on her performance. Now listen carefully. Initially, she was expecting to get a job on permanent basis, but they have just offered her on a temporary basis for how many months? 9 months. After that, it depends on her performance. Either her job will be permanent or not. Can I say, look at this. If you put yourself in the shoe of, hey, yes, just try to think. You're joining an organization. You had in your mind that I'll go on a permanent basis, but the company says no. We will give you a chance for 9 months and we will simply see your performance. If your performance is good, then we'll make you our permanent employee. So if this is the case, seriously, it's a human nature. In order to save your job, in order to make your temporary job to become permanent, there are simply, I would say, there's a self-interest threat. You know that your performance is evaluated in first 9 months, and on the performance of first 9 months, your job status will be decided. Either it will be simply terminated or make it permanent. So there is an ethical issue, which is self-interest threat. So there's a possibility just to make your job permanent, you might be taking out the actions which are not ethical at all. The reason is self-interest. There's an issue of self-interest. Okay, she reports to the finance director under pressure from the finance director, Ms. Hayes, Hayes has produced an optimistic analysis indicating 50 million investment will be worthwhile and will achieve the board's objective. Now look, under the pressure from FD, Ms. Hayes has produced an optimistic analysis. Now listen. Actually, when you are working in an organization, you should not be working under the pressure of someone. If you're working under the pressure of someone, it impairs your objectivity, it impairs your independence. You are ACCA. Why you are working under the pressure of someone? If you're working under the pressure of someone, then obviously your objectivity is impaired. You don't have any independence. Okay. Ms. Hayes is aware from the recent press reports that similar football teams have had to spend significantly more than 50 million to achieve this result. This analysis has not yet been sent to the bank. Ms. Hayes is concerned that Bayfloat will face a cash flow shortage within 12 months of the reporting date. This is dependent on the club's future performance, its ability to renegotiate OD facility, and the company's relationship with its key stakeholders. The board has told Ms. Hayes that going concern assessment is not required and that she's to make no reference to the financial difficulties Bayfloat financial statements. Most members of Bayfloat board include the finance director and ex-professional football player. They are ex-professional footballers. Mr. Hayes has never played football professionally and believes that as a result, the board does not respect her opinion. Okay, now. So far, the thread which you have seen is a self-interest threat is there. Objectivity will be impaired. Independence cannot be seen here. Plus integrity. It means if Miss Hayes hides the things and deliberately goes with the incorrect information, so it raises the question on the honesty of Miss Hayes. It raises the question on the honesty of Hayes. So how many issues are there? Number one, when you are working under the pressure of someone, your objectivity is impaired. Number one, it means you don't have any independence. So your objectivity is impaired. Another issue is if self-interest threat, to save the job, to protect the job, to make your temporary job to become permanent, there are chances Ms. Hayes might not be providing each and every information. Another issue is integrity, honesty of Hayes. If Hayes actually knows each and everything, and if she's hiding from the, let's say, seniors, and or she's not disclosing each and everything, it means it raises the question on the honesty as well. Plus, if there is a going concern problem, look at this. Hayes is concerned that Bayfloat will face a cash flow shortage for the 12 months of reporting date. This is depending on the club's future performance, its ability to renegotiate OD facility, company's relationship with key stakeholders. The BOD has told Hayes that going concern assessment is not required. Why not? She is to make no reference to the financial. Now listen, students. If you're working somewhere and you know that company is going to have a cash flow problem in the next 12 months, and let's say if you assess that problem is going to be very severe and that could affect the going concern assumption of the company. If this is the case, then with the going concern assumption is not valid, then entire financial statements will be made by using net realizable values. Another thing is, Miss Hayes never played a football professional and believes that as a result, board does not respect her opinion. See, actually, either they respect your opinion or not, you have to actually provide them true and fair picture. You have to at least negotiate them. You have to inform them that business will have a problem in next 12 months. There's a shortage of cash. There's a chances that going concern assumption might not remain valid, but you need to discuss all this. So what ethical issues are? First, you have to highlight the ethical issues. There's one problem is self-interest. Second, she's working under the pressure of FD, it means objectivity. If she's hiding the information, it means integrity, honesty. She's not being honest. So we have to be honest. So simply, she has to inform FD each and everything. Plus, if FD is not listening, then she should contact even with the non-executive directors. Even they are not listening, she can even take the advice from ACC. I don't think so that ACC will have that much time, but you can just write. And let's see. Miss Hayes has only recently been appointed to her role on a temporary account. And this gives a self-interest threat to objectivity because she will not want to take action which may reduce the chance of her being made a permanent employee. We have also highlighted this object, that is self-interest. Knowingly producing an incorrect analysis for the bank demonstrates a lack of honesty, integrity. It is important that Ms. Hayes does not submit the incorrect analysis to the bank. It may be that Ms. Hayes is subject to an intimation threat. It was mentioned that due to the pressure from FD. As she is under the pressure of finance director, as a professional accountant, Ms. Hayes should not allow her action to be influenced by the pressure from finance director. Okay. She should discuss the assumptions with the finance director and corroborate them based on past experience and public information. If the assumptions are found to be over optimistic, the analysis should be revised based on realistic assumptions. Financial statements are relied upon a range of primary users to make economic decisions. It is important that these users are not misled. If there is a going concern uncertainty, then in accordance with IAS 1 presentation of financial statements, this should be disclosed. However, before Ms. Hayes is required to assess the range of information about the company's ability to continue as a going concern. It may be that buy float has sufficient cash to continue trading for 12 months from the reporting date. However, if Ms. Hayes still believes there's a going concern uncertainty, she should raise this concern with the finance director or other members of the Bay Float board of the director. This may, however, prove difficulty due to the pressure from the finance director, the lack of diversity in the board, and fact that Ms. Hayes feels her opinion is undervalued. Ms. Hayes may therefore need to raise concern with the non-executive directors or with external auditors. Even she should also consider seeking advice from ACC or legal professionals. Of course, now listen, student, I think I mentioned this again many times earlier also. Nobody is expecting from you to answer with such a great volume, which right now is in front of you. But if you can highlight the main point, like self-interest threat was there, there was an intimidation threat from FD as well, objectivity was impaired, and what she was required to do, she was required, and plus she was not required to hide the information. It means if she does that, then integrity becomes questionable. Plus, if there's a going concern assumption is not valid, so you have to, in fact, you have to discuss this with your FD directors. Even you take the advice from ACCA. Plus, if the going concern assumption is not valid, so obviously entire financial statement, they will be made at net realizable value basis. But I would say, student, a very manageable question, provided that students, they have answered this question with a cool mind without coming into the panic. So question number 2, I would say a very much manageable question. Question number 3. Before the discussion of question number 3, there's no need to go anywhere. Just a quick 5-minute break, please. No need to go anywhere. I'm not dropping any message on the WhatsApp group. So please stay here. Just a 5 minutes break. Okay, dear students, before we discuss the question number 3 of March-June 2025 SBR, let's revise the relevant area which we need for those questions. IFRS 15, revenue from contracts with customer. The area which they examined was contract modification. A contract modification is a change in the scope or price of a contract. Okay. The modification is accounted for as a separate contract. Now, there are two possibilities when there are modification in the contract. Then there are two possibilities. Either modification is treated as a separate contract, or modification is not a separate contract. Now, listen to me carefully. We have to discuss when modification is treated as a separate contract. Of course, when modification is treated as a separate contract, then your existing arrangement, they will remain as it is, no change at all, and the new contract will be dealt separately. But when the modification is not a separate contract, then IFRS 15 says treat this end of your existing arrangement, end of your existing contract, and recognize the altogether a new contract. And the revenue which you will be earning in the new contract, it will be unrecognized revenue of the previous contract plus the additional revenue due to modification. But that will happen when modification is not a separate contract. Now, let us first develop the understanding when modification is treated as a separate contract. The modification is accounted for as a separate contract if the scope of the contract increases because of the addition of distinct goods or service. Distinct means which we can differentiate. So the scope of the contract increases because of addition of a distinct goods, differentiating services. That is a modification. And one more thing. The price increases by an amount that reflects the standalone selling prices of the additional goods or services. Standalone. Just an example, okay? Assuming your organization made a contract with XYZ company, assuming, okay? And that company, what it does, assuming they just provide repairs services to the entire factory. For example, it could be repairs of, let's say, even electrician repairs. It could be any repairs, but relating to that building. And the contract is for 3 years. Fine. After 1 year, your company says to the same organization which is providing you the repair services, assuming that company also provides security services. I'm just assuming. Now your company asks that company that in addition to the repair services, you people also give us a security services. Of course, security services, they are distinguished from the repairs. Plus the price which that company is asking you to pay, it's a standalone price. For example, they told you that if we provide the security services, we normally charge $10,000, assuming per month. We'll be charging the same amount. One, it is altogether different than what we are providing through existing arrangement. And second, we are asking a standalone selling price. In that case, this modification is a separate contract. It will not affect your existing arrangement. Treat that security arrangement as an additional new contract. But look at this now. Both the condition must be met, okay, students? One, it has to be distinct goods or services, and the price must be a standalone selling price. If not accounted for as a separate contract, if I'm not taking that as a separate contract, the modification will be accounted for as termination of existing contract and creation of the new contract. If the modification is not a separate contract, obviously there will be one thing out of two. Either modification will be a separate contract or modification will not be a separate contract. If modification is not a separate contract, then IFRS 15 says this is the termination of your existing contract and the creation of a new contract. If the remaining goods are, of course, distinct from those transferred before the modification, the transaction price for the new contract is the total of original consideration unrecognized and the additional consideration promised from the modification. That is the second point. Now, third point, part of original contract. If the remaining goods and services are not distinct from those transferred before the modification and so form a part of a single performance obligation, this modification will impact the contract price and the stage of the contract completion. It is dealt with the adjustment of the amount of cumulative revenue recognized at the modification date. For example, we were providing the repair services earlier, and due to modification, only the scope of repairs work has increased. If this is the case, it's just a part of the original contract. If the remaining goods and services are not differentiating from those transferred before the modification, so form part of a single, then it's a part of a single performance obligation. The modification will impact what? It will impact the contract price. It will impact the stage of contract completion. Now, come here. Modification, remaining goods and services are not differentiating. The reporting entity, a construction company, enters into a contract to construct a commercial building for another company. 1 year later, both companies agree to modify the contract by changing the floor plan of the building. This results in an increase in the contract price. The remaining goods and services to be provided under the modified contract are not differentiating, not distinct from the services transferred before the date of the contract modification. This is because the contract still contains one performance obligation, which is construction of a commercial building. Consequently, the reporting entity accounts for the contract modification as if it was a part of the original contract. Cumulative catch-up adjustment will be required. For example, earlier the transaction price was 2 million, now it has become 3 million. Assuming you have already the work which you have done, it was equal to 1 million. For example, your work which was completed, it was equal to 1 million. So initially the price was 2 million. So it means 50% work was completed. But if the transaction price from 2 million, it becomes 3, then 1 upon 3 means your work is actually completed 33.33%. So basically it affects the transaction price, it affects the percentage of completion. When the modification is not a differentiating products, goods or services. Now look at this. Even though we have discussed this earlier also, but it's important to revise right now so that we can go to the past paper. Part A says discuss with calculations. How much revenue should be recognized in relation to the above by reporting date? Salty enters into a contract to supply 1,000 products to Sweet for $60 each. 1,000 products, the price is 60. The products are transferred over an 8 months period and control passes on delivery. After Salty has transferred how much? 700. Still how many products are left? 300. 700 products, the contract is modified. to require an additional 200 products. So remaining 200 additional, remaining were 300 products additional to altogether 500. Okay. The contract is modified to require an additional 200 products to be transferred. So total becomes 1200. Okay. The price of additional 200 is 57, which is a standalone selling price. At that date, contract modification, can I say? Number one, your products are distinguished, because actually distinguished product means when I'm providing the goods or services simultaneously. Your custom distinguished means even I have delivered 100 products, your customer will be able to get the benefit. Your customer is not going to wait for the remaining products to be delivered in order to get the benefit. So goods are here distinguished, number one. Number two, due to modification, we will be providing 200 additional products. But can I say, when it says the price 57, then question says, which is the standalone selling price? Can I say this is contract modification, number one? Second, the products are distinguished, plus due to standalone selling prices. So can I say the contract for the 200 products should be treated as a separate contract? Student, is that clear? It's a separate contract. It will not be treated like this, that your existing contract is over. No, no, no. Because look at the price, it's a standalone price. So simply here the modification means a separate contract. All the criteria is met. By the reporting, we Salty has transferred how many products? 900 products in total. So basically 200 additional 200 should be treated as a separate contract. Just a minute. Let me just quickly share the answer of this with you. Look at this. The contract modification is accounted for as a separate contract because the products are distinct and the price increases reflects the product's standalone selling prices. By the reporting date, control over 900 of the products under the original contract has transferred. So revenue 54,000 will be recognized. Let's go back. Just a minute. Okay, now let's come in. Now let's discuss part B. This will give you more information. Discuss with calculations how much revenue should be recognized in relation to the above by the reporting date if the contract specified a price of $40 for additional 200 products, assuming the normal standalone price. Can I say for additional 200 you are charging 40, which is not a standalone selling price? If it is not a standalone selling price, goods are distinct, but the problem is you are not charging a standalone selling price. Now here the modification is not treated as a separate contract. Now here the modification means termination of your existing contract, and we need to recognize the new contract. Under the new contract, your total revenue will be unrecognized revenue. How many products were left? 300. Can I say into 60 plus additional 200, and we'll be charging 40. So 60 into 300 plus 200 into 40. I'm getting 26,000. So 26,000 revenue will be recognized for how many products? 500 products. Logically, per product, you will be recognizing a revenue of 52. By the end of the year, 900 products you have transferred. So already 700 you have transferred into 60. This is your existing arrangement, but remaining 200 will be at the rate of 52. Now repeat, goods are distinct, but the problem is you're not charging a standalone selling price. When you're not charging a standalone selling price, this modification will not be treated as a separate contract. Here, this modification means termination of your existing contract plus altogether creation of new contract. And what will be the cumulative total revenue of the new contract? Total revenue of the new contract will be unrecognized revenue from the existing arrangement plus the revenue which will be coming due to modification. Let's see quickly. Look at this. The contract price increases does not reflect standalone selling price of the goods. So the modification is not accounted for as a separate contract. Because the goods are distinct, it should be accounted for as a termination of existing contract and the creation of a new contract. By the contract modification, 700 goods had been transferred, so the revenue of 42,000 should have been recognized. Now that the original contract is deemed to be cancelled and transaction price should be determined for the new contract, this is unrecognized consideration from the original contract plus additional consideration from the promise from modification. After the modification, further 200 products were transferred to Sweetie. So the revenue should be 10,400 for these 200 products. Altogether, it will be 52,400. So I strongly believe now it is very much clear to everyone when to actually treat modification as a separate contract and when to treat modification as the end of existing arrangement and creation of a new contract. Now let's go towards the past paper question, which we actually need to discuss. Now, let's see the requirements first issues. First 8 marks question. Using Exhibit 1 in accordance with IFRS 15, revenue from contracts with customer, discuss the accounting implication of 2. Contract modifications over the contract terms. Contract modifications, IFRS 15. Men's company prepared financial statement in accordance with IFRS accounting standards. Functional currency is the dollar. So there's a, I would say, flavor of IAS 21 can also be seen because they have used the term functional currency. Normally, we use this term in IAS 21. It has a financial year end December X7. The following exhibit available on the left-hand side of the screen provide information relevant to the question. Contracts. Outline 2 contracts with customers to provide information technology services. What are we providing? We are providing information technology services, IT services. Let's stick to first one. On January X7, Ments agreed to contracts with 2 different customers. Under both contracts, Ments agreed to provide information technology services to each customer for how many years? 4 years. When initially agreed, each contract contained a single performance obligation. We know that if there are multiple performance obligations and all are distinct, then you have to allocate your transaction price on each performance obligation. Contract 1. On January X1, The contract price was agreed $6,000 per year, 60,000, my bad. The contract included a clause allowing the customer to cancel the fourth and final year of the contract by paying a total penalty of $10,000. Actually, there's a contract for how many years? 4 years. But if client wants, they can cancel the last year. But if they really want to do that, they have to pay us how much? $10,000 as penalty. This decision had to be made by December X7. So by the end of first year, if you want, you have to make this decision by the end of first year. By December X7, the customer informed Ments of its decision to cancel what? Final year contract. And it paid how much? $10,000 penalty on the same day. Now, students, just read it once again and try to make a decision that how should we deal with this, how to treat this question. Should we go for a separate contract or just, I would say, termination of existing arrangement and recognition of the new contract? We have just revised the relevant part. So you have to just think a little bit, not more, I would say. But directly, you are not going to answer. First, obviously, you have to, I would say, first you have to discuss what IFRS 15 says. You have to mention that. Students, any answer from your side? Where is everyone? Students, actually, if you look at the question, what is actually happening? We are providing what? IT services. Okay. We have already given IT services for 1 year. Now, according to the contract, 3 years are left, but the customer has already informed us that this customer wants to actually cancel the contract. It means now we will providing the services for the next 2 years. We will be providing the services for the next 2 years. Student, is that clear? Yes or no? Please reply. We will be providing the services for the next 2 years. So logically, next 2 years means 60,000 into 2. But this will not be the only revenue which I'll be recognizing. Plus, we will also be recognizing this 10,000. Altogether, it becomes 1,30,000. And this 1,30,000 will be recognized over 2 years. You will not be recognizing this. Just you will not be recognizing 10,000 immediately. Is that clear, students? Actually, still the single performance obligation is still there. Plus, we are not getting any separate contract. So what is happening? We are saying, okay, let's terminate the existing arrangement. Now, according to the new arrangement, we will provide you the services for the next 2 years. And we are getting the penalty amount as well. So basically, we will be recognizing logically in next 2 years 1,30,000 as our revenue. But directly, you're not going to answer. If you answer that directly, you won't be getting the marks. Look at this. According to IFRS 15, revenue from contracts with customer, a contract modification is a change in the scope or price of the contract which has been approved by both parties. Examiner is not answering directly. First, examiner is discussing the relevant area. A contract modification is accounted as a separate contract if the scope of the contract increases due to the addition of the distinct goods and services. If the price increases to reflect standalone selling prices of these. If the modification does not add distinct goods or services, but remaining goods or services are distinct from those already transferred, this is treated as a termination of the existing contract and creation of the new. However, if the remaining goods or services are not distinct from those already transferred, the modification is treated as a part of. Can I say, students, pure copy paste from your notes from the Kaplan book? Yes or no? Pure copy paste. I would say whatever examiner has written is pure copy paste. It has no link even with the right now with the question. No application. This is pure knowledge sharing. Student, you can see that whenever such a question comes, do not directly jump for the application. First, you have to share the knowledge. Now, contract one, modification does not result in the addition of distinct goods or services, so not accounted as it's not a separate contract. Although the contract only contains a single performance obligation, the remaining services to be provided are distinct from those already transferred. Ments must treat this modification as the termination of existing contract and the creation of the new. This contract for prospectively. Remaining consideration is 120 plus 10,000. Should be recognized over 2 years. I strongly believe that contract one should be clear to everyone. Well, look at how examiner has answered. First, examiner has written the 3 scenarios. When to treat a modification as a separate contract, when to treat modification end of existing arrangement and the creation of the new contract, and when to treat modification as a part of original contract. Then examiner went for the application. Examiner did not go directly for the application. Go back to the question. On January X7, the contract price was agreed 72,000 per year. Okay. December X7, Ments and the customer agreed to change the contract to add an additional service to the contract. The service represented a separate performance obligation. As a part of the change, the customer agreed to pay a total contract modification fees 2,500. In addition, the contract payments were increased from 72 per year to 90,000. There's a rise of 18,000 per year. From January X1, the increase in the annual payment was based upon the normal selling price of additional services. Can I say, student, this change, this modification in the contract must be treated as a separate contract? Yes or no? All the conditions of separate contracts are met. Please look at this. The service represents a separate performance obligation. As a part of change, customer agreed to pay this increase annual payment based upon normal selling price of the addition. Can I say this is the first case when modification is treated? Number one, the modification is for distinct goods and services. Second, standalone selling prices are being charged by your company. So this modification is altogether an additional contract. Existing arrangements will be there and there's a separate contract. Student, please reply on this. And how much you will be getting for this separate contract? You will be getting, technically you will be getting 18,000 per year. Plus you have received the fees for 2,500, but this 2,500 you will not be recognizing immediately. You will recognize over the contract period. Can I say the remaining contract terms are 3 years? Why 3 years? Initially, each contract was for 4 years. And the modification is coming on January X8, means after 1 year. So logically, this 2,500 modification fee, you are not going to take it revenue right now. It will also be recognized over 3 years. So your existing arrangement will be there. Plus every year, additional revenue will be 2,500 divided by 3 plus 18,000. So from the new contract, student, from the new contract, every year your company will be having a revenue of 18,833. And from the existing contract, every year your company will be having a revenue of 72,000. But here you can see the modification. This modification is a separate contract. Why it is a separate contract? Number one, it is for a distinct goods and services. Second, you are charging a stand-alone selling price. When it is for a distinct goods or services, plus I'm charging a standalone selling price. So this is an additional contract. Your existing arrangement will remain intact, plus you will be accounting for a new revenue from the new contract. Let's see what examiner has done. The services provided after the contract change have increased and distinct from those provided before the contract modification. The price of the contract has also changed by an amount consideration which reflects Ment's standalone selling prices of the additional promised goods or services. The scope of contract has increased, and so Ment should treat the modification as a separate contracts, and Ment should amount for this prospectively. With regard to the existing contract, revenue should continue to be recognized 72,000 per year. With regard to the new contract, revenue should be calculated and recognized as the sum of the increase per year 18,000 plus the modification fee spread over the remaining 3-year terms. So every year you will be recognizing 18,833 from the new contract, and existing is 72. So total revenue from here onwards every year will be 90,833. I strongly believe student contract 1 and 2 must be clear to everyone properly. Let's go back to the question. In fact, before the question, just a minute. Let me share the relevant part. First, we'll revise that. Okay, students, let's have a quick revision of reassessing the lease liability. Sometimes what happens, you will see that there's a change in the lease terms. Then you have to reassess the lease liability. For example, lease liability has increased. If it has increased, so how will you adjust? Right of use asset amount will be adjusted, and lease liability amount will also be adjusted. If changes to the lease payment occur when the lease liability must be recalculated and its carrying amount adjusted. Obviously, the corresponding change goes to the right of use asset. A corresponding adjustment is posted against the carrying amount of right of use asset. IFRS 16 says that lease liabilities should be recalculated using a revised discount rate. Student, look at this, please. Revised discount rate. Everyone knows that we use implicit interest rate in the lease term if it is known by the lessee. Even your examiner has given you the implicit interest rate in the question, and the question says lessee does not know about anything about the implicit interest rate. Even still, you will be using incremental borrowing rate, even though it is implicit is written in the question. But examiner says lessee does not have the information of the implicit rate, then I'll be using lessee's incremental borrowing rate. But what IFRS says, if there are changes in the lease term, then you have to reassess the lease liability. When I'm reassessing the lease liability, then I'll be using a revised discount rate, revised, not the original one. If the lease term changes, the entity assessment of an option to purchase the underlying asset changes. Initially, you might thought you are going to buy, now you're saying I'm not buying. Or initially you thought I'm not going to buy, now you're saying you will buy. The revised discount rate should be the interest rate implicit in the lease for the remainder of the lease term. If this cannot be readily determined, the lessee's incremental borrowing rate at the date of reassessment should be used. Okay, now come here. Discuss how the lease will be accounted for during the first year of contract. on the first day of the second year of the contract. On January X1, Kingfisher enters into a 4-year lease for property with annual lease payment is 1 million annual, okay? Payable at the beginning of each year. According to the contract, lease payments will increase every year on the basis of increase in the consumer price index of the preceding 12 months. If in previous 12 months there's a rise in the consumer price index, then lease payment will increase. The consumer price index at the commencement date is 125. The interest rate implicit in the lease is not readily determined. Kingfisher's incremental borrowing rate is 5% per year. At the beginning of the second year of the lease, the consumer price index is now 140. So initially it was 125. Now you are saying it is 140. So they are asking what will happen during the first year and on the first day of second year. Just to save the time, quickly look at this. You people have done this question earlier as well. The first payment occurs on the commencement of the date, so it including the initial cost of the right of use asset, debit, cash, credit. This is the initial cost. The first payment occurs on the commencement of the date and is include the initial cost of the right of use asset. The liability should be measured at the present value of the lease payment not yet made. The payments are, because we know that in first payment there is no interest if you're paying in advance. The payments are variable as they depend on the index. They should be valued using index at the commencement of the date. It is assumed that index will remain at 125. So it means 11x2 you'll be paying 1, then 11x3 you'll be paying this. So first year discount rate, second year, third year. So this is the present value. Right of use asset debit and lease obligation credit. Actually, we are paying rental in advance. So obviously, when you pay first rental in advance, there is no interest payment. So simply right of use asset debit, cash or bank credit. The asset is depreciated over the lease term. So this is the depreciation of your asset. Now come here. Depreciation, right of use asset, carrying amount of right of use asset. This is accrued interest at the year end. Finance cost debit, lease liability credit. So lease liability table year end 2.72 opening, accrued interest, this becomes your closing liability. Now the first day of the second year, this is important. There are 3 remaining payments to make. The payment for the second year is now due, which is 1.12. Why? Because as compared to the previous preceding 12 months, now your index, consumer index has changed. So from 1 million, it has become 1.12. The lease liability is remeasured to reflect the revised lease payment. Now look at this, 1.12. This is, you are already at 11x2. Technically, it is T0. That is why it is coming 1. Now look at this. Your lease obligation has become 3.21 from 2.86. So right of use asset will increase and the lease liability will also increase. And one thing, we discount at 5% initially, still we discount at 5% because in this question, examiner has not given us the revised, I would say, incremental borrowing rate or revised implicit interest rate. It is categorically mentioned in IFRS 16. Then when you are reassessing the lease liability, you should be using a revised discount rate, provided that it is given to you. Obviously, if revised discount rate is not given, then I'll be using the original one. But let me repeat, we have just seen as well. Too much emphasis was on use the revised discount rate. Then simply a payment of lease obligation, debit, cash, credit, then right of use asset will increase to this, will be depreciated over the remaining lease term. Okay, now let's go to the question. Just a minute. Great, we are back. Question, part B. 8 marks. Using Exhibit 2 in accordance with IFRS 16 leases, explain how to account for the lease agreement in financial statement for the year ended December X7. Read the requirement again. It's pure IFRS 16. Exhibit 2, in accordance with IFRS 16 leases, explain how to account for lease agreement in financial statement. First, you just need to explain how to account for the lease agreement in financial statement. Okay, let's see. January X1 means a lessee entered into a 2-year lease for its head office. The annual lease payment were agreed $5 lakh per year, payable on December each year, at the end of each year. The implicit interest rate, the lessee was not, the implicit interest rate the lease, in the lease was not easily determined, but meant incremental borrowing rate was 5%. So obviously we'll be working on 5% on January X1. On January X1, the present value of lease payment, they have given us 9,30,000. Logically on 117, can I say right of use asset debit by 9,30,000? Your lease obligation credit by 9,30,000. We are paying the rental at the end of each year. If you're paying the rental at the end of each year, then logically what happens? Finance cost, incremental borrowing rate is 5%. Rental payment, December X7, 9,30,000. 5% of 9,30,000 is 46,500 is the interest, and how much rental will be paying? 5 lakh. So 9,30,000 plus 46,500 minus 5 lakh. 4,76,500. Let me recheck. 9,30,000 plus 46,500 minus 5 lakh. Perfect. This is your lease obligation. Okay. Of course, right of use asset will be depreciated over 2 years. Now, what is happening? December X7, after the lease payment was made, both parties agreed to extend the lease term by 1 additional year. The annual lease payment remained 5 lakh per year. On December X7, meant incremental borrowing rate increased to what? 6%. Now, listen, student, carefully. Now, we have to calculate the present value of the next two payments at 6%, not at 5%. Why? Because it was categorically mentioned in IFRS 16 that when you are reassessing the lease liability because of the change in the lease term, then use the revised discount rate. Right now, this is your lease obligation. Your right of use asset is 9,30,000 divided by 2. Just a minute. Your depreciation for the first year is 4,65,000. So logically, right of use asset carrying amount is also 4,65,000. Now what are we going to do? We'll be simply calculating the present value of next two payments. Date. Next payment is going to be December X8, 5 lakh. December X9, again 5 lakh. Revised discount rate is 6%. Am I right? Whatever the value comes, we will increase, we will adjust the carrying amount of, we will adjust the, can I say we are going to adjust the carrying amount of lease liability? Simply will increase the carrying amount of lease liability as well as right of use asset. Let's see quickly. I strongly believe this is clear to everyone. Look at this lease remeasurement. In accordance with IFRS 16, lessee must remeasure the lease liability to reflect changes to the lease payment. There has been an increase to the lease term from 2 to 3 years. So the revised remaining lease payment should be discounted to present value using revised discount rate. This becomes the remeasured lease liability and corresponding adjustment is recognized against the right of use asset. Now this is the present value of lease obligation. Your lease obligation from 4,76,500 to increases to this. Your double entry of 44,196 will be right of use asset will be debited by this amount and lease obligation will be credited. So I strongly believe this is clear to everyone. Please reply. We are not directly discussing the question. I'm just first giving you the revision of the relevant area so that you can recall what you have already studied and then apply in the question. Let's go back to the question paper. Using Exhibit 3 in accordance with IFRS accounting standards, explain with the calculation of the bond should be accounted for in the financial statement for the year ended December X7. Okay. Meant as a functional currency dollar. Now listen to me carefully, students. IAS 21. Functional currency is the currency of primary economic environment in which your entity operates, number one. Number two, IAS 21 says in case of monetary items, you have to translate them on transaction date, then you have to retranslate them on each SOFP date. Changes due to exchange rate. If there's an exchange gain or loss on monetary items, that exchange gain or loss goes to P&L, goes to income statement. Plus, you should know one more thing. If there is either interest income or interest expense, then that should be translated by using average rate. That should be translated by using average rate. There are two occasions in IAS 21 where we use average rate. One is in case of accrued interest or interest income. The second is if you have got an overseas subsidiary, the entire P&L of overseas subsidiary is translated by using average rate. Now let's see. Plus, when you're making investment in bonds, always remember when you're making investment in bonds, so we treat bond as a monetary asset. Because in case of bonds, you exactly know that when you will be receiving how much interest you are going to get, and at maturity, what amount you will be getting it. That's why we say it's monetary. But if you're making investment in shares, investment in share is non-monetary. January X7 Ments purchased a bond for its fair value 2.7 million dinars. So we have to convert 2.7 million dinar to the dollars because our functional currency is dollars. So dinar is our foreign currency because foreign currency means which is not a functional currency. So every currency other than functional is a foreign currency for us. The bond does not pay annual interest. It's okay. It means bond is not paying any cash interest. However, Ments will repay its investment plus a significant premium in 4 years' time in dinars. The effective rate of interest, see, the coupon rate is 0%. Technically, a coupon is 6% or 0%, but effective rate is 6% because at maturity, your investment will be redeemed with the at premium, which is in line with the market rate of bonds for this level of risk. Ments intend to hold the bond until maturity. Can I say this point is good enough for me to think for an amortized cost category? It is quite obvious by looking this, I'll go for amortized cost category. Because I'm not going to go for fair value through P&L category unless examiner categorically, if examiner says we made the investment in bonds for short-term trading purposes only then investment in bond will go for fair value through P&L category. Otherwise, I'll go for amortized cost category. Exchange rates for the year ended, they have given us ratio is from dollar to dinars. Dollar to 1 dinar. Now, logically, students, it is like this. Because actually, if you read the question nicely, it should be clear to you. Dollar is weaker and dinar is stronger. Why? Because $1.1 they are equal to 1 dinar. Please, student, you should be a little bit good in this sort of maths. $1.1 is actually equal to 1 dinar, or you can also say dollar per dinar. Dollar is a local currency. Dinar is a foreign currency. Then in financial management, we say it's a direct quote. In direct quote, rule of translation is multiplication. When we'll be converting foreign currency to local, we multiply. So either you go by the ratio or go by the direct quote. Direct quote rule of translation is multiplication. It means in day one, 2.7 million into 1.1, that will be your investment in bonds. I'm getting 2.97 million. Okay. Then December X7, the rate is 1.6. Okay. There's an average rate which I'll be using on my interest income. Now, by using effective rate, you will get interest income. 2.7 million dinars. Effective rate is, if I take 6% of this, logically, I'm getting 0.162. In interest income in dinars, I'm getting 0.162. Is that clear to everyone, students? Average rate is 1.3. This will give me the interest income in dollars. This is 1.3. Students, I'm getting 0.2016. Now, please try to understand. Initially, your investment in dinar was 2.7. There's an effective interest of 0.162 in dinars. So, logically, in dinars, investment becomes 2.7 plus 0.162. In dinars, your investment becomes 2.862. This one we have already translated. It becomes 2.97. This one we have already translated. It is 0.2016. Now, since investment in bond is a monetary asset, so we have to retranslate by using closing rate. Closing rate is the rate on SOFP rate, which is 1.6. So in your financial statements, it is coming 4.5792. In your financial statement in SOFP, this is your investment amount. This will go to P&L and there's an exchange gain. Let's see how much. 2.97 plus 0.2016. The total is coming 3.1716. The difference of these two is exchange gain. And that exchange gain, of course, goes to P&L as well. So 4.5792 minus 3.1716. Student, there's an exchange gain of 1.4076. Let's see what examiner has done. The debt instrument plus student, you have to also discuss little bit about the impairment as well, because there's an investment in bond, amortized cost category, IFRS 9. You should be giving a reference of, I would say, impairment accounting as well. Debt instrument contains a contractual obligation to receive cash, so it should be recognized as a financial asset in accordance with IFRS 9. Financial instrument, the bond should be classified as to measure at amortized cost. This is because the business model is to hold the bond until maturity, and contractual cash flows, which are market rates, reflect interest on principal amount outstanding and repayment. The financial asset initially will be at 2.7 plus transaction costs, but there is assumed to be nil. In accordance with IAS 21, effect of changes in the foreign exchange rates, transactions should be translated into entities' functional currency by using a spot rate. Interest income is calculating using effective rate 6%. The amount is one. They're taking the complete values, 1,62,000. This is translated by using average rate. This increases the carrying amount of financial asset and is recognized as income in the P&L. The bond is a monetary asset. In accordance with IAS 21, it should be retranslated into entities' functional currency using the exchange rate at the reporting date. Exchange gain. The carrying amount is presented as non-current asset on the statement of financial position. Exchange gain this. P&L. In accordance with IFRS 9, a loss allowance should be recognized based on 12 months lifetime expected credit losses. This will reduce the net carrying amount of the financial asset with a corresponding expense charged to the P&L. I strongly believe the calculation, everything should be very, very clear. Students, please reply on this. Let me pause the video. Okay, so let's start the discussion of last questions of today. But as I mentioned at the start of the class, that coming Saturday, inshallah, the class is going to be longer than this. Okay, be ready, because the time has come that you have to show up for the live classes. This is for your own benefit. Question number 4. The term is March, June 25. Let's read the requirement. Okay, it's a 25 marks question. Using Exhibit 1 in accordance with IFRS accounting standards, explain how to account for the purchase of trademark on January X7 and discuss the issues to be considered when subsequently accounting for the trademark in the year ended December X7, 8 marks. Student, first you need to divide the requirements. Explain how to account for the purchase of trademark. First, you have to tell us, how should I account that purchase of trademark? Simply, at which value should I recognize it? Number 1. And then discuss the issues to be considered when subsequently accounting. Obviously, trademark is an intangible asset. Then subsequently, under IAS 38, what should be done? If I have a trademark for a specific number of years, then I should be amortizing it. If I have the trademark for indefinite period, then I will not be amortizing it. But according to IAS 38, if your intangible asset is having an indefinite life, then obviously you cannot amortize that intangible asset. But instead of amortizing, then every year you have to perform impairment test irrespective of the indicators of impairment loss. Because there is a possibility after 1 year, 2 years, 3 years, there's a possibility initially you were saying that this trademark will be there forever. For example, there's a possibility after a few years you will say, no, now maximum 4 more years, maximum 5 more years. So simply every year you have to perform impairment test. One more thing, under IAS 38 intangible assets, there are two models. One is cost model and another is revaluation model. But according to IAS 38, it is mentioned in the IAS that normally for the intangible asset which company is having, normally the suitable model is a cost model, because revaluation model is only available when there is an active market for the intangible asset. Let's go for part A first, then we'll be discussing others. Students, so very good, looks very good question. And in this June 25 attempt, one of my students took 87 marks in SBR. They are very impressive marks, seriously. Because previously highest marks which I had, they were 85. Now alhamdulillah 87. But the biggest highest marks so far which I have, that is in two papers. One is taxation 99 and the second is FM 94. Then FR 92. PM is 85. So ATX is 83. AFM is also 83. SBR now 87. So thank God. Let's see. Rita company prepares its financial statement using IFRS accounting standards. The financial year end is December X7. The following exhibit available on the left hand side of the screen provide trademark. Provides information about the trademark purchased by Rita. Trademark. One of the Rita's business activities is the manufacture of food for human consumption. Okay. On January X7, Rita purchased the trademark for a popular breakfast cereal. Nowadays, it is very common. Okay. People are, I would say, more health conscious, which is good. The consideration transferred by Rita was 6 million of its own $1 equity shares with a fair value of $2 each. On 1st January X7, a market expert valued the trademark for $10 million. Now listen carefully, students. Right now, what is happening? Rita, this organization is buying a trademark by issuing their own equity instruments. Basically, it's an equity settled share-based payment transaction. I should be thinking for IFRS 2 share-based payment transaction, because we are buying the trademark and we are giving the consideration in the form of shares. IFRS 2, number one. Number two, listen it nicely. Equity settled share-based payment transaction. We are buying the trademark. We are providing the consideration in the form of our own shares. It is written in IFRS 2. If you're buying a property, plant and equipment, and you know the fair value of that property, plant and equipment, for example, if you know the fair value of the goods, then if you know the fair value of the asset acquired, asset purchased, then it will be recognized at its fair value. That is, we say direct measurement. But if you don't know the fair, if it is difficult to determine, it is difficult to decide the fair value of goods which you are purchasing, fair value of the asset which you are purchasing, then there will be indirect measurement, and that indirect measurement will be, then we will assign the value to that asset according to the value of our equity instrument. That is indirect measurement. But of course, here we should be recognizing the trademark at 10 million because it has a fair value. So you'll be discussing a little bit IFRS 2. Then, of course, trademark will be recognized at 10. Okay. After that, of course, on this trademark, I will apply IAS 38, intangible asset. Management estimated that the trademark had an indefinite useful life and it was acquired because the trademark produced was expected to generate net cash inflows indefinitely. Stop here. Now you'll be discussing. Then according to IAS 38, when intangible asset is having indefinite useful life, then company cannot amortize the intangible asset. But every year, company will have to perform impairment review, irrespective of the indicators of impairment loss, because there is a possibility after a few years, there's a possibility life from indefinite could become definite. If it becomes definite, then it will be amortized over its remaining useful life. However, a few months later, several discount supermarket launched and a similar products without breaching the trademark. And Rita experienced an immediate 35% reduction in the sale of the trademark product. Management estimate that the net cash inflows will stay at this lower level for the foreseeable future. However, due to popularity and recognizability of the trademark, management expects that the product will continue to generate these lower net cash inflows again indefinitely. Now listen carefully. Even though there's a reduction in the revenue, but still the management and the expert, they are confident even at a lower trademark will not be, we won't be generating the same revenue which we were generating earlier, but lower net cash inflow will keep coming and they will keep coming forever. They will keep coming indefinitely. So still we, even after this payment, we will not be amortizing this trademark because it is still have an indefinite life. But here obviously we will advise them that you should try to perform impairment test. And in impairment test, what happens, we just compare carrying amount with the recoverable amount. Recoverable amount is higher of fair value minus cost to sell and value in use. If the carrying amount is more than the recoverable amount, then difference is the impairment loss. And if carrying amount is not exceeding the recoverable amount, then there is no impairment loss. So these are the things what you need to discuss here. Let's see quickly what examiner has done. According to IFRS 2 share-based payment, the purchase of trademark is an equity settled share-based payment because goods or services has been acquired in exchange for Rita's company's own shares. Because this is an equity settled share payment, Rita should measure the trademark and the corresponding increase in equity directly. Using the fair value of the trademark received, the fair value of the trademark was reliably measured at $10 million. And so this is the amount at which the transaction should be recognized. In accordance with IAS 38 intangible asset, trademark is an intangible asset because it is non-monetary and has no physical substance. As such, an intangible asset should be recognized at 10 million. A corresponding credit is posted to equity. Of this, 6 million is recorded as share capital and the remaining 4 million I hope am I audible? Students, am I audible? Please quickly reply. Because I'm having a technical issue. Students, am I audible? Please, let's me check. Am I audible? Something went wrong here. Okay, that's great. Thank God. Okay, I'm audible. That's great because there is a electricity issue a little bit. Okay, that's great. Oh no. Just a minute. Just a minute. Subsequent treatment. Intangible assets are amortized on a systematic basis over their estimated useful life, but are instead tested at least annually for impairment. An intangible asset is assessed as having an indefinite useful life when there is no foreseeable limit. to the period over which the asset will generate future benefits for the entity. There should be an annual review to determine whether the correct assessment. The trademark have declined significantly. These are still expected to occur indefinitely. This means that there is still no foreseeable limit to the period over which the trademark will generate future benefit for reader. The trademark therefore has an indefinite life, so no amortization. December X7, an impairment review pairing 10 million carrying amount of intangible asset with its recoverable amount. IAS 36 impairment of asset defines recoverable amount as the higher of fair net future cash and beneath. And you just want IFRS 2, IAS 38, and little bit discussion on IAS 36. That was the something is seriously wrong, I believe. No, nothing is wrong. Just a minute. I hope. That's great. Just next requirement is here. Divisional structure outlines the reader's divisional structure. Briefly discuss the usefulness of segmental reporting. Can I say IFRS 8? Segmental reporting. IFRS 8 is helping investor to better understand the performance of the entity. There is no need to refer to the exhibit. Student 4 marks and they're just asking one thing. Usefulness of segmental reporting. Just listen it nicely. 4 marks. Okay. Number one, you have to simply explain to your examiner that there are a number of organizations which are diversified. It means they're not running one business, they are running number of businesses. When they're running number of businesses in different industries, so each business will have different growth prospects, different opportunities. Then you will be, after that, you will be also giving the information that under IFRS 8, we provide detailed disclosures to the user of financial statements. Due to those detailed disclosures, user of the financial statements, they can make a better economic decision either to invest in an organization or not, because due to the disclosure of operating segments, users of the financial statement investor, they will get to know which segment is performing better than other segments. There's a possibility that without the disclosure of operating segments, there's a possibility some of the segments they are performing really good, other segments and they are not performing good. So due to the good performance of few segments, bad performance of other segments could be simply hidden. But after having all the knowledge and all the information of IFRS 8 disclosures, users, they can make better decision because they will exactly know that from which division, from which segment, how much company is generating, how many assets are in each segment, what are the liabilities of each segments, what are the expenses of each segments. If you have time, then you can also discuss that traditional ratio analysis, they do not provide detailed information because traditionally we perform ratio analysis on consolidated books. Why we say consolidated books? Basically, if my company is having 4 different products, so obviously the revenue which is coming in the P&L, it is not representing one product. It represents all the 4 products. So you will never know that which product is actually generating how much revenue. But due to the application of IFRS 8, now users of the financial statement investor, they will get to know which product, which division is performing, either their performance is good or bad. So this is what you just need to read it once also. Thank God the electricity is here. Okay. B2, using exhibit to discuss whether the division operating units would be identified as Rita's operating segment. Now listen, student. In order to be an operating segment, there should be 3 characteristics. Number 1, when we say operating segments, so that segment should be engaged in generating revenue and incurring cost. On this basis, we say your operating segment is a profit center. Second, there should be a CODM, Chief Operating Decision Maker, whom you are reporting, and CODM is assessing your performance, and after assessing your performance, CODM is actually allocating the resources. Third, discrete financial information should be available. Discrete means we should be exactly knowing that what is the revenue of your division, what are the expenses of your division, what is the value of assets in your division. That is discrete financial information. So operating segment means which engages in generating revenue, incurring costs, and there's a CODM. And the last one is discrete financial information. If all the characteristics are met, then simply that segment is treated as an operating segment. Okay, now the last one, then we'll go towards the question. Using summarized financial information in Exhibit 3, explain which of the operating segment should be separately reported in Rita's operating segment disclosure. Wow. Student, reportable segments. Can I say, in order to become a reportable segment, your segment has to pass 1 test out of 3. If you recall, 1 test is revenue test. How do we perform revenue test? We take segment revenue divided by total segments revenue. Passing criteria is greater than or equal to 10%. And then there is asset test. How do we perform asset test? Segment asset divided by total segments asset. Again, the passing criteria is 10% or more. Then we have got profit, or you can say loss test. How do we perform this profit or loss test? For example, if I'm performing profit or loss test on segment A, assuming segment A is having a profit, so in the numerator there will be a profit of segment A, but in the denominator, there will be a total of profits or losses, whichever is higher. For example, 3 segments are having profit, 4 are having loss, and loss is greater than profit. Then in the denominator, the amount of the loss will come. And obviously, while performing the test, I will ignore the negative sign. Passing criteria is again 10% or more. Now listen, it is not necessary to pass all of the tests. Even the segment passes 1 test, it becomes reportable segment. And when the segment becomes a reportable segment, then you have to disclose each and everything with the name of that segment. And there's one more test. To decide the reportable segment, the last test is called 75% threshold test. The last test is 75% threshold test. Now, what do you mean by 75% threshold test? According to IFRS 8, reportable segments external revenue should be at least 75% of entire companies or all the segments external revenue. Simply 75% threshold test is applied on external revenue. Reportable segments external revenue should be at least equal to 75% of the total enterprise external revenue. If 75% test is not met, then you have to make few more segments reportable so that you can achieve 75% threshold test. Now let's go to the question. Now the OneNote is working nicely. This, Alhamdulillah, great. Retail company has 6 operating units, which are grouped into 3 divisions. Division: operating unit home, personal products, home products; food, home food, animal food; beverage, fruit drinks, sports drinks. Each of the 6 operating units has responsibility to produce a particular set of products. None of the units trades with each other. Can I say this means they do not have internal revenue? None of the units trade with each other. There is no internal revenue. Okay. The manager of each operating unit produces a monthly financial report. The chief operating officer reviews the information to assess unit performance and to inform decision about resource allocation. There are 3 divisional operating officers who produce divisional financial reports on annual basis. We'll discuss this. These reports are also reviewed by COO. The CEO is your CODM. Look at this. Home personal product revenue. Can I say simply, they all are meeting the definition of operating segment. How? So you can see that I can see a chief operating decision maker is here, whom they are reporting, and chief operating decision maker, after assessing their performance, is making the decision to allocate the resources. But there is only one thing: they all are operating segment. We have seen discrete financial information they have also given us. They do generate the revenue as well. There are 3 divisional operating officer who produce divisional financial report on an annual basis. Now on this you can say that the frequency is very low. This is within the company. Why you are providing report? Why the reporting is on annual basis? Should have been on monthly basis. Why annual basis? Now let's come here. Now we have to check which division, which segment is a reportable segment. It's very simple. We have been given all the revenues are external. Okay, there's no internal revenue. Total is here 280. Can I say 50 divided by 280 will give us the percent? Let's make it very easy. If you take 10% of 280, it becomes 28 million. So all the segments, they are having revenue either 28 million or more. They are reportable. Logically, can I say personal product home is reportable? Home products on the basis of revenue test is not reportable. Home food is reportable. Animal food is reportable. Can I say fruit drinks and sports drinks, they are not reportable on the basis of revenue test? Is that clear to everyone? Because according to the revenue test, your revenue of that segment should be at least 10%. So what I did, the total revenue is 280 million. I took the 10% of 280, which is coming 28 million. So every segment which is having a revenue either 28 million or more obviously passes revenue test. So right now there are how many segments? Can I say 3 segments are passing the revenue test? One is personal product one, human food one, and animal food. Now let's go for profit or loss test. A student, profit is 9, 11, 19, 6. So can I say profit is higher than the loss? What is the total of profit? 9 plus 9 plus 11 plus 19 plus 6. The total profit is 45. Now listen, if I take 10% of this, it is 4.5. Any segment which is having either profit or loss equal to 4.5 or more is a reportable segment. This one is a reportable segment. No, yes, 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 and no. Acid test 397, take 10% of this. You will get 39.7. So any segment which is having acid 39.7 or more is a reportable segment. Yes, no, yes, 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 and even yes. So logically, only one is not reportable, not passing any one of the tests. Rest, this is also no. 32. Less than 39.7. Logically, sports drinks and home products, they are not reportable. All other are reportable. Now we have to check 75% threshold. It is mentioned in the question, there's no internal revenue. It means entire revenue is external. And 75% threshold says the reportable segment's external revenue should be at least equal to 75% of total company's external revenue. Total revenue is 280 million. Now let's take 50 plus 55 plus 50 plus 55 plus 117. This is also reportable. Plus, because I've already discussed, we have already discussed, to become reportable, not necessary to pass all three tests. Even a single test is passed, segment becomes reportable. So reportable segments, external revenue is 247 divided by 280. Students, I'm getting 88.2%. It means no need to make any other segment reportable because 75% threshold is met. Now let's see what examiner has done. Students, usefulness of segmental reporting, you have to read it only once whenever you have a time. Look at the operating segment. According to IFRS 8, an operating segment is a component which generates revenue, incurs costs, whose results are regularly reviewed by the chief operating decision maker, for which discrete financial information is available. The unit manager who reports directly to the chief operating officer each have a responsibility for a particular product and produce regular financial reports for CO2 review. This suggests that 6 individual operating segments are separate segment of RETA. For a component to be an operating segment, the financial information about the operating results of component should be sufficiently detailed, enable to CODM to make decision about resources to be allocated to assess performance. This is the case with the 6 operating units. The divisional reports are only annual. Decision making would be difficult if there was only one report per year. Therefore, this seems to suggest there are 3 division, not operating segment of return. But based on the above, it is likely that operating segment for reporting purpose should be 6. Now look at the reportable segment. They have written that all the test, 75% threshold. Now come here. Revenue test, pass. They have passed the revenue test. They are calculating percentages, 50 divided by 280. Yes, yes, and yes. Just a minute. If you come here, please. We said on the basis of 50, yes. 55, yes. 117, yes. What we did? We took 10% of 280. The answer was 28 million. I think our approach was little bit, I would say, smarter, time saving. 10% of 280 is 28 million. So any segment which is having revenue either 28 or more simply will pass the revenue test. Now profit or loss test. Yes, 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 and yes. Then asset test is yes, yes, yes. Now look at this. The 75% threshold. I think we did calculate this 88.2%. The other 2 operating segment would report it as all other categories because 75% threshold is also met. So students, I strongly believe this question is also clear to everyone. So students, we have alhamdulillah discussed the question number 2, 3 and 4 from the March, June 2025 attempt. And this is the answer to the number of questions. Students, they all keep asking one question. The question which was coming from the student, and which is a genuine question, I would say, and they do ask in every attempt also. Sir, that do we discuss the recent past papers? And I always reply, yes, I always reply, we do discuss, but we discuss during the live revision classes so that you can also get the opportunity to try the question. So I hope that today I've given the proof. And this is not only in SBR. I'm doing the same thing in AFM, in ATX, even in my skill level papers. In every paper, we are doing this. So this is the evidence in front of you that today we have discussed. Alhamdulillah, June 25, March 25, past paper question. We have discussed 3 questions. Students, you can see that today's class was the longest of all, I would say. Coming Saturday, inshallah, my plan is to discuss at least 5 or maximum 6 questions. All will be from the recent past papers, which are not on the portal. Obviously, something which is already on the portal, so we will not be discussing because you can take the video from there. Plus, you might have noticed one thing if you're there from the start of the class. We did not directly discuss the question. First, I've given you the revision of the relevant area, and then we have discussed the question. So this coming Saturday, the target is to discuss at least 5, otherwise 6 questions, and then there will be a complete 1 class on consolidation. We will be revising the entire consolidation through questions. So students, thank you very much. Is there anything you want to say before I end the class? So, and I would request, do give the feedback on today's class in your relevant WhatsApp groups. That actually motivates your tutor.